All right.
Okay,
So
perfect.
we're going to get started in about one more minute. We have a lot of people joining us, and Karen and I are really excited about that. What we can tell you is these slides are as hot off the press as they can get. From 4 minutes ago, we are literally changing things as things are coming down on the internet as fast as we can. And so what we're going to be talking about today, and we are so glad to have all of you guys on the call, we're going to be talking about all the recent legislation that has been passed by Congress and all the different opportunities that are out there right now. And some of you have businesses, some of you represent businesses, and so everyone kind of has a different perspective. But we've got so much to tell you today. And I wish we could be brief, but we cannot be brief. So I hope you'll stick with us on this. We've got a lot to tell you. So let me kind of tell you who's on the call today. My name is Lisa McKinney. I've been a faculty member at the university for 17 years. I started my career at PricewaterhouseCoopers. And that's an interesting alliance that Karen and I have. I am so pleased to be co-presenting with Karen Miller, who is a recent addition to our faculty, who was a tax partner at PricewaterhouseCoopers for 8 years. She has been so much fun to work with on this. Everyone absolutely loves her here. We're so excited to have her on board. She is truly a technical genius at tax. And so she flatters me in everything that we're going to do today. I want to also mention Tiara Dorsey, who has provided significant contributions to what we have put together. And so I really want to recognize her as someone who's added a lot of practicality. Karen and I are tax nerds, so we think a lot in terms of technical aspects and legislation. And what Ms. Dorsey has been able to provide is the practical on the street type of knowledge. So Karen, so glad to have you with us. Thank you.
Thank you, Lisa. It's a pleasure to be here this afternoon. And as you said, the good news is we do have a lot of content because we have so many opportunities that are available for businesses to benefit from these stimulus provisions. So this is definitely a good problem to have, a lot to talk about for a good reason.
Thank you, Karen. So we'll be your presenters today, and you can kind of see what we're going to talk about. This is hot off the press. It's stuff that's happened in the last month. We got our first taste with the Families First Act, and we got some good news in that. But then the CARES Act really provided us with so much stuff. The hottest thing to talk about right now is the PPP loan. So of course, we've got to dedicate a lot of time to that. But Karen, am I correct that the CARES Act is the most expensive piece of tax legislation passed ever?
That's correct, Lisa. You know, it's hard to believe because we just had a major piece of tax legislation passed not too long ago, literally just 2 years ago. And at that point, we all said, this is the most significant piece of tax legislation that we have seen in over 30 years. We never would have dreamed that less than 2 years later, we would be saying the same thing about another piece of legislation. So you're right, with a $2.2 trillion price tag on this, it will be the most expensive package, and we could see that price tag continue to increase, as we'll talk about in a minute. There are some things potentially coming down the pipeline that will be additional provisions that could add another $250 billion or so to this price tag.
Just another $250 billion.
That's right. At this point.
So the only loser we'll see today is the deficit of America is the loser.
That's
and we'll
right.
deal with that later. But right now we need to be printing a lot of money because this is very expensive. So we're going to kind of start with the most important stuff because it's the thing everybody's talking about. The CARES Act specifically was passed at the end of March, and it did a lot of things. And we're going to talk about the 3 items in red. Obviously, we're going to have to dedicate a lot of time to the PPP loan because that's what everybody's talking about. But we're also going to point out some alternatives, some options where the PPP loan may not work out for you. We're having a lot of struggles with that. But right now we're going to move into the first topic, which is unemployment benefits. During this presentation, you'll be able to present questions to us. Those of you that have presented questions to us, we have addressed and we have had added to our presentation. We will also, throughout the presentation, you'll have the opportunity to send in those questions, and at the end of the presentation, we'll absolutely make sure everyone gets a chance to ask their questions. I don't think you'll have that many because Karen and I really tried to nitpick this. But our first topic is what was at first a very controversial topic that got employers kind of excited, but the extension, the increase of benefits by $600 a week for 4 months. What I want to point out is you do not have the traditional restrictions of you've already taken all your benefits, you don't have sufficient employment history, or you're a part-time worker. What we do need to note that you cannot request these benefits if you are able to work at home remotely, or if your employer is providing you the leave benefits we're going to talk about later that provide some tax benefits to them. Now, Karen, one of the most interesting things that you and I have been talking about is how this will vary significantly by state. And I want you to kind of talk about specifically Alabama. We've got a lot of people on the phone that could not be from Alabama, but this is a very interesting topic. Tell us about this, Karen.
Right, and as Lisa mentioned, this really is hot off the press. We just got this update literally less than 24 hours ago from the State Department of Labor. And the good news is that the additional $600 payment will be added to the recipient's or otherwise normal state weekly benefit amount, which again, for Alabama purposes, our maximum was $275 per week. So that could vary on a state-by-state basis. So if we do have individuals joining us from other states, you'll want to check with your State Department of Labor to find out what your state's maximum is. But from an Alabama standpoint, the $600 will be added to, again, the former weekly maximum, which was $275 a week. The great news is for all of those applications that had been processed, they started paying claims as of April 8th. So that money, we're told, should start appearing in bank accounts, hopefully within 2 to 3 days. And so if you were already processed and through that application portal with the Department of Labor, you should start to see that additional benefit very quickly. Now, those benefits will be paid for a period that will go from March 29th of 2020 through July 25th of 2020. So we're looking at still a few more months of potential eligibility. The great thing that the state has done, the Department of Labor has put together an absolutely amazing chart that is very specific and takes a lot of different individual circumstances and outlines exactly what the individuals can expect to receive and what they're entitled to receive. So Lisa has posted the website link up on the screen now, and we've got an excerpt from that chart. I apologize, the font is very small. You'll see when you open the State Department of Labor link that there is an expansive chart that walks through each and every possible scenario that an individual could have. And it gives very clear guidance on what type of unemployment benefits you potentially could receive and what the amount would be. So we'd encourage all of you, based off your specific facts and circumstances, to go out and take a look at this because it's incredibly helpful, and I think we'll walk you through exactly where you would fall. Now, one of the most common questions that we're getting is, can I apply for these unemployment benefits and take advantage of some of these other beneficial provisions like the PPP Loan program? Unfortunately, that answer is no. They're not allowing us to double dip or benefit from multiple federal programs, so just keep that in mind. You do have some choices that you will need to think through, but at this point, it's not possible to benefit from both.
Thank you, Karen. That's great. That just came off the press yesterday. Again, that was specifically for Alabama, but that chart was phenomenal. They've done a great job. I am very close to a certain small business owner that is my husband, and also talking with other small business owners, what I had firsthand knowledge was the perspective of a small business owner. When we all heard about these unemployment benefits, every small business owner thought, should I lay off my employees or should I try to continue to pay them through all all these federal programs. And so, in talking to small business owners, literally including my husband, I collected this as a kind of a list of the things they considered. It seems like at first you would want to lay off employees because of these great unemployment benefits, but when you really look at it and you consider all these great tax benefits you get and these loans that you have, you really need to consider the non-tax, the non-monetary considerations. And so one of the things a lot of them were talking to me about is, I have some valuable employees. I don't know when I'm going to be able to open my doors again, because we don't know when things are going to turn around and be safe again. So one of the benefits to using these PPP loans, using these tax credits we're going to talk about, was you had this workforce that was still ready to go. And so we got to always mention monetary issues, tax issues aren't always at the forefront. There are a lot of practical considerations. Also, we don't really know, if you laid off all these people, we don't know for sure what would happen to your unemployment tax rate down the road. We just don't know. There has to be down the road some kind of provision where we will recoup these funds. Will that be through an increased unemployment tax rate? I'm just not sure about that, but there's a lot going on. We're also hearing about the great difficulty getting through the unemployment phone systems. You hear these stories of a guy trying to call in 300 times. So there's a lot of practical considerations. Now, here's our big star topic of the day. Everybody wants to know about the PPP loan. Really want to make sure everyone understands this could potentially be free government money. So the word loan is not the right word, is it, Karen? It could be a grant. And so we're going to go through all the details and talk about it. There are so many details. And so at first, what you see is that this loan is available for people with under 500 employees. We're going to see there's a lot more that might be included in that. And we obviously have to talk about how that applies to self-employed independent contractors. But we've got two considerations: what qualifies for the loan and what qualifies for forgiveness. The main gist of it is the government wants to reward you if you are willing to keep these employees on the payroll. Now, Karen, one of the things you and I have been talking a lot about is this concept of affiliation, and that the first test is 500 employees, but you can be treated as one company for purposes of this rule, right? And I want you to kind of help me understand when we have to worry about affiliation and when it might be waived. We've been discussing the fact that industries are exempted from the 500 employee test, and that there are additional small business tests that we can meet that you were talking to me about. Depends on industry.
That's right. So it's very important. You're going to hear a lot in the press about this 500 employee standard. And as Lisa said, there are some rules in place. If you own multiple businesses and you control, as we'll talk about in just a second, the management of those businesses, or have a significant voting interest in all of them, there are certain situations where you may have to aggregate those businesses for purposes of determining the number of employees that you're deemed to have. But the good news is we do have a number of exceptions as well. So I think the moral of the story today is, if you do think you have more than 500 employees, definitely check into some of these exceptions, because we're hearing more and more that for some industries, as Lisa mentioned, they have alternative ways to potentially satisfy these criteria. And those alternative ways are under the existing guidelines of the Small Business Administration. They have a definition for a business that's called a small business concern that is industry specific. And so you can see differing standards based off the number of employees or the size of the business from a revenue standpoint as well in some cases. But in many cases, it would allow entities that possibly do have more than 500 employees to still qualify for this very beneficial loan program. So we would encourage all of you, based on your industry, Lisa has put up the website through the Small Business Administration. You might want to take a look at that definition for your industry, see how that term small business concern is defined, and it's possible that you could see that maybe there are some exceptions that would allow you to go north of that 500 employee figure. There are also some alternative definitions based off the net worth of the business and based off the recent income history of the business as well. So a number of areas that, so don't be taking a second look at the Small Business Administration site for your industry to see if there are exceptions.
So that SBA.gov /size is where we need to go, right?
That's right. The SBA.gov size portal will give you those specifics for your industry. It is important to know your code too for your industry, as we noted at the top of that slide as well.
We've got a website for that, right? The
That's right.
NAICS code. Yeah. Okay, great.
That's right, because we know that that's something that a lot of people probably don't know off the top of their head.
And
if
Karen,
you are,
go ahead.
Oh, I'm sorry. It's like, oh no, go ahead. I was just going to say, so coming back to the affiliation, I know we've got a lot of questions that have been coming in about that, because we do often see individuals will have an ownership interest in multiple businesses. And so it's important in the affiliation area to consider not only the actual percentage ownership that you have, but also the types of management activities that are being controlled by perhaps the same individuals. So those are the two main areas that we need to look at, as well as the issue related to family members, where you've got situations where you have a number of family members that overlap and control multiple businesses. Those can sometimes be aggregated together under the affiliation rules as well. So you want to make sure that you're looking at your close relatives for purposes of this application and documenting every situation where potentially you could be deemed to be affiliated. Now, the reason that's important, as you talk to your lenders, you'll have them tell you the applicant is the one who is responsible for making all of the representations related to these affiliation tests. So it's really important, if you are signing off on that application and representing that you have met these thresholds, that you do the work to make sure that you're not going to be caught on one of them, because this is one of the key representations that you're making as part of the loan application process.
So to kind of sum it up, Karen, what you're saying is there's a 500 employee test. That all of your businesses that are under your control could be treated as one for the affiliation test. So you could go over the 500 employee rule if you bunch all your businesses together. The affiliation rules are really broad, aren't they?
They are. They can cast a broad net. So it is important to think about all three of those categories of affiliation. You're right, Lisa.
Okay, so moving on to something else. There's a lot of, you can see a lot of dates on this slide. One of the neatest things about this is that if you have laid off workers, you have the opportunity to bring them back onto the payroll in connection with getting this loan. And so we're going to talk a little bit more about that, about what that means, how many you have to retain. There is some flexibility we'll talk about in a minute. We know that today is the day applications open for the self-employed. 1 week ago was the frenetic day where banks were bombarded with requests. But loans will be available until June 30th. But Karen, you and I have been talking a lot about the political excitement going on right now. You would think $349 billion would be enough. But I think on the first day, wasn't there an astronomical amount of requests? So that right now, you and I were talking about the debate in Congress over adding another $250 billion. Can you tell us a little bit about that?
That's right, Lisa. So as you mentioned, last Friday was the big day where we first saw the portal open up for applications. And today that portal opens up for all the independent contractors and self-employed individuals as well. And based off the high level of interest that came in starting last Friday, there was immediate concern, believe it or not, as quickly as Monday, that the original $349 billion that was allocated was not going to be enough to cover the level of interest for these loans. So not surprisingly, quickly on Monday, President Trump got involved, sent out a tweet, I think Mitch McConnell not too long after him, expressing their support for the expansion of the program and adding potentially another $250 billion to the available amount. Now, at first, it seemed very optimistic at the beginning of the week that we could quickly see that $250 billion added. Since that time, there has become a mess, really, in Washington in terms of the debate between the Senate leadership and the Democratic leadership in the House. Unfortunately, they are now squabbling over some of the terms and what else should potentially be added if there is an expansion of this program. So we're not quite as optimistic today as we were on Monday, but I think we'll still see continued dialogue over the next few days. But it is important, Lisa, as you said, the program is open technically through the end of June, but it is first come, first serve. So they continue to tell everyone it's very important to get your application in as quickly as possible, just in case we don't see these dollars expand. So that's the message of today. Definitely get your application in quickly.
Don't wait till June 29th. And I
That's
like
right, because
wobbling in Congress is a constant, but this is a big one, $250 billion. Now, the two things that we need to talk about now, Karen, are one, the maximum amount of the loan, which is a completely different determination than the amount that can be forgiven. So the maximum loan is 2.5 times your average monthly payroll costs for the last year. And what Karen and I have been talking to lenders about is it was originally written to be a rolling period of the last 12 months, depending on when you requested your loan. But what we're seeing is it's actually the banks are like, just give me calendar year 2019. That's easy, and let's roll with that. Now, there are some special rules for seasonal businesses. And Karen, when you and I were talking about this, the concept of a beach condo was, what have you been seeing about seasonal businesses?
Right. So, not surprisingly, one of the key questions that came out early on was, what happens if I'm a seasonal business? Because one of the key rules for this program is that you had to have been in operation on February 15th of 2020. Well, we have a number of seasonal businesses that may have been closed because that's historically a down period. And that would include a lot of those businesses at the beach that close and don't reopen until March 1st, because that's when spring break traffic starts to pick up. So what we now know is that the lenders will have the ability to look at your operations for 2019 for the period from February to June of 2019 for purposes of analyzing your application. So just because you had a seasonal business that may have been closed down technically on February 15th does not mean you're excluded. But the important thing is to talk to your lender about that. As we'll say a lot of times today, a lot of these provisions are at the lender's discretion. So it is really important to understand your lender's policies and how they view these provisions.
So we're talking about the maximum amount of the loan. We said 2.5 of your average monthly payroll costs. So we've got to define payroll costs. And we've been nitpicking through this. Obviously, it's compensation. We're going to get more into the nitty-gritty of this, including tips and such. It does include the leave, severance payments and such. It also includes group health insurance premiums paid as a fringe benefit, retirement benefits paid by the employer. And then the interesting one here that we have not received much guidance on was the state and local taxes. And would these, Karen, be the ones that were paid for by the employer? Is that what do we know about that?
Now, this, provision is one where we are hopeful we will get more guidance in the coming days. It's raised a lot of confusion. So right now, we think this may be the type of state tax that is paid in a partnership context, potentially, where you have partners that are having to file a composite return. Some of you that are in partnerships that have business in multiple states may have had to file those before. That's what the thinking is on this. But I will tell you, as we'll talk about in just a second with some of the other partnership considerations, this is one of the areas where we're still lacking significant guidance. And so we need a little bit more from the Small Business Administration and the Treasury to be able to fully understand. So this is just the normal state tax that you would see being reported through payroll taxes. And at this time, we think it's a little bit of different concept that they're looking at here.
Now, you and I were also feverishly trying to find as much information we could about guaranteed payments. So those of you that are partners or involved in partnerships, we know that a partner doesn't get a W-2. They get a guaranteed payment reported to them on their K-1 for the partnership. And what we don't have guidance on is Is that a payroll cost? So what do we know right now, Karen, or do we know anything about that?
This has been one of the most frustrating areas as we continue to get updates throughout the week. And as Lisa referenced, some of these updates have been coming in multiple times a day at all hours of the day. But I think everyone has been shocked that we still have a big open item in this area. The guidance that has been released so far from the Treasury Department and the Small Business Administration has just not addressed the guaranteed payment area for partners at all. So that is certainly a big area of discussion in DC right now. I think the importance of getting that guidance out is being highlighted to everyone at both the Treasury Department and the Small Business Administration. So we're hopeful that we will see some guidance coming out in the next few days. But as of right now, if your business is operated as a partnership, it's important to understand we do have some uncertainty in this area related to those guaranteed payments that you as partners may be receiving. So again, that's another area that you want to be talking to your lender about and making sure that all of you are on the same page in terms of the rules and guidance that may be today.
Thanks, Karen. And what we also understand, if one person is compensated an annual rate of more than 100,000, you cap at that person's payroll costs at 100,000 for you, divide that by 12 for that monthly. But we also received clarification that 100,000 is only the cap on the compensation. You can include health and retirement, right?
That's right. That's the good news, that when you look at that 100,000 cap, it refers to more what we would traditionally consider cash basis compensation. So a lot of the benefits, such as the health and retirement benefits, are not included in that cap. So that is one piece of good news that we received some clarification on earlier this week.
Now here's another exciting area. There is still some uncertainty exactly of how things apply to independent contractors. So when we're talking about independent contractors, at this point, we're talking about someone that gets a 1099 miscellaneous payment, so they're treated as self-employed. And so the clarification we received in the last few days is those don't count as payroll costs, but it's a different mechanism because the independent contractor is the one, in this case, that's going to request the loan. And in that case, the independent contractor requesting the loan is going to compute their maximum loan based on their Schedule C net profit. And you had helped me understand the fact that if you haven't filed your 2019 return, what should you use as the guide, Karen?
Yeah, so we did talk to some of the lending officials, as Lisa mentioned earlier this week, to find out, because we know a lot of people have not yet started the process of filing their 2019 return, particularly in light of the significant extension that we got a few weeks ago. So what the lenders recommended is that you take your best shot using your 2018 Schedule C from your tax return as your guide. Again, you will need to use updated 2019 numbers, but you could take a look at that 2018 Schedule C from your tax return and use that as a roadmap to help walk you through the different categories that you would need to consider. Now, the other good news for independent contractors, we did get some clarification this week from the Small Business Administration that you can also use your average monthly, what we call 1099 compensation. So if you're receiving a 1099 from whoever you're performing services for as an independent contractor, you can use that average monthly 1099 income in calculating your base that will become your maximum loan amount. So that was helpful as well, because many people do have their 1099s readily available. They can easily divide that annual amount by 12 months to get a rough approximation of what that would be.
And what we always keep repeating, which may be irritating, is you cannot double dip. So
That's
keep
right.
notice that you cannot get a PPP loan and get unemployment benefits here. You cannot take these tax credits and get a PPP loan. You've got to choose your battles, and we'll kind of talk about some of the considerations in doing that. Something very similar is the concept of a sole proprietor and how that works with the PPP loan. So here we're talking about Schedule C, someone that doesn't get 1099s but does have income as a proprietor, and the rules look like they're pretty similar here, right, Karen?
That's right. Thankfully, for all of the ones that we have been talking about for the independent contractors, similar provisions would apply for sole proprietors as well. So you're still looking at your Schedule C as a basis for this. Same provisions again, if you need to look at your 2018 as a roadmap to try to construct what that would be for 2019, it sounds like the banks are willing to let you use that approach. So a lot of overlap in these rules, which is good. And, you know, the one thing that will a lot of the industry, there is some diversity in terms of the calculation approach that the banks are using. So it's important to understand that, again, your lender may have specific thoughts about some of these components. So you're going to want to have a proactive discussion with your bank lending officer to make sure you understand if they're using a specific calculation model or approach, what components they're pulling in.
Your lender, your banker is your best friend right now. Be real nice to them.
That's
Bring
right.
them some baked goods. And if there were a fraternity or sorority member with you, maybe you have a leg up or dated them, whatever. But it's nice to have a good relationship with a lender. Now, here's the neat thing is the details of the loan will be the same for everyone. And the interest rate, boy, has this gone back and forth. What we got in the beginning was it will not be more than 4%. And then they tossed out 0.5% per year, an annual rate of 0.5%. And what did the bank say to that one, Karen, when the 0.5% came out?
When they saw the 0.5%, you can imagine, you know, the banks were already not excited about potentially having to do all of this work because it is a tremendous amount of work on the application process. The 0.5%, needless to say, was not well received among the banking industry, and the American Banking Association quickly pushed back on that. So we did see some quick action. The interest rate was raised a couple of days ago to 1%, which is not a huge jump, but it's better than 0.5%, which is what they had. So it is a 1% rate over that 2-year term. And again, you know, the payments can be deferred for potentially 6 months. The one thing to note is interest will still be running while that payment is deferred.
Thanks, Karen. And the whole point of this is a great low interest rate loan, but what we're all gunning for is that bullet point in red. What we really want is to meet the requirements of forgiveness. And so now we'll move into that. You have to use those funds within 8 weeks of receiving the funds for what are eligible costs. So we'll get into that in a minute, but one more thing we really need to talk about that you and I have been on the phone with lenders about, specifically want to thank Tiara Dorsey for helping us with this one as a lender. The legislation said the borrower cannot be charged any fees, but what just came out, I think you stayed up all night last night, Karen, and I don't think you slept because what you told me this morning was that you just found out that the federal government will be compensating. Can you tell us about that?
That's right. So just to clear up the confusion on the fees, you as the borrower cannot be charged any fees. So if any institution that you're dealing with is trying to assess a fee, we have been told by those in the banking industry, you should immediately take note of that and think twice about whether this is a scam or not, because it's very important to know the borrowers cannot be charged any fees. The way that the banks are being compensated for this is that the federal government will be paying a fee directly to the lender, so here, the financial institution. That fee will be based off the size of the loan. It starts at a level less than $350. There's a 5% fee for that level, but it goes all the way up to $10 million, which is our max under this program. So that fee rate could be 5%, 3%, or 1%, depending on the size of the loan. But absolutely, there are zero fees to the borrower. The fee will be paid by the government to the lending institution instead.
And your point well taken. Watch for scamming because it
That's
always
right.
comes up, and this is a huge opportunity.
Unfortunately.
So now we need to move into, you got the loan, your max loan was based on 2.5 times average monthly payroll costs, but a totally different calculation is how much is forgiven. Notice here what is included in forgiveness, not just payroll costs, but rent, utilities, and interest on existing debt. So you can't go out and take out another loan right now. It has to be existing debt. But that's pretty amazing to make. We really need to make sure that distinction is made. The max of the loan is based on payroll costs. The amount forgiven includes these common costs, but only these costs. So rent, utilities, payroll, and interest. not principal payments. What we also need to note is the whole point of this is that we're trying to get you to maintain your payroll levels in both the number of employees and an amount they're paid. So there's going to be a 25-75 ratio of 25% of what is forgiven must be payroll. 75% of what is forgiven must be payroll. The other 25 can be your rent, utilities, and interest. And this was a neat point we were discussing the other day about an anomaly, maybe a glitch. Tell us about this, about how you need to be careful here with the difference in the maximum computation and the amount forgiven, Karen.
That's right. As Lisa mentioned, the majority of people who want to participate in this program are hopeful going in that they will be able to get the full amount of the loan forgiven and that it will become a grant. But it's important to remember, as we talked about, the maximum amount of your loan is up to 2.5 times your monthly average payroll cost. So when you think about 2.5 times, that's 2.5 months, which is closer to 10 weeks of compensation that's being used in determining the maximum amount of the loan. Now, what can be forgiven is only 8 weeks, and that 8-week clock starts running from the time that the disbursement happens from the bank to you. So there is that 2-week disconnect. So it's really important as you're thinking through this to remember that what will be forgiven is based off the 8-week period. You may potentially be eligible for a loan, though, up to 10 weeks. So remember that if there is a disconnect for that 2 weeks, that becomes a loan that you are responsible for repaying, albeit at a very low interest rate. So it's just something to keep in mind. It was something that caught some of the initial borrowers last Friday by surprise. So for those of you that are just eligible to go into the portal today, we wanted to make sure you were aware of that potential 2-week disconnect. It's just something to think through and be mindful of.
That's a really good point. Thank you. The other thing you and I were discussing this morning even is trying to find more guidance on what exactly, when will forgiveness be allowed? There is a provision in the legislation that says that your loan forgiveness will be reduced, taken away, if you don't meet the requirements of maintaining payroll. And so what we were looking further into is, what does maintaining payroll mean? And one of the examples I think we read in some articles was about a restaurant that had reduced to takeout. The requirement to maintain your full-time employee headcount would be difficult in that case. And what we've given is guidance on, it literally says, you have to keep your employees, the number of employees, and then the salary has to be maintained at a level where you can't reduce it more than 25%. What do we know about the actual headcount number? We expect more guidance. What do you think is going about that?
Right. So as we look at the head count, that was another thing that caused a lot of concern, because people said, well, wait a minute, if I lose even just one person, do I potentially see a significant reduction in my loan amount that could be forgiven? And thankfully, the answer is no, you shouldn't be penalized severely. You will see a reduction in the forgiveness, but it's based off the ratio of the number of full-time employees that you have during this period to either what you had in January or February, or what you had in the comparable period last year. So there would be some scale back, but again, it will be based off that ratio, which ultimately depends on the number of employees in total that you have.
Do we expect that we'll get a computation? Do we expect we'll get guidance with that computation, you think?
I think so. I think we'll see more guidance around that point, and the potential reduction that could occur if you decrease the salary of any employee who is making $100,000 or less. I think we could see some additional guidance on that as well.
Thanks, Karen. That's, you know,
Sure.
the at-the-minute things. Now, another thing we were bringing up was, we know that sometimes when your loans are forgiven, that the government will treat that as income to you. But in this case, we feel like we don't have to worry about that here. But what's really interesting, and I want you to talk about, is they provided an exclusion, which means for tax on something, but they didn't put that exclusion in the tax code. And the Florida that kind of has been trying to address this. Is that correct? What do you know about that?
That's right. So the great news is, for federal purposes, whatever amount of the loan is forgiven will completely be excluded from taxable income. So you will not have to pay tax on that as you otherwise might have had to do in a normal loan forgiveness situation. So that was wonderful news at the federal level. The one thing that we're seeing, and this will likely require states, as Lisa alluded to take some action over the next couple weeks or months, is that the way that this law was written, and this can often happen when laws are written quickly, that provision for the exclusion of the income was added to a part of the overall U.S. code that unfortunately is outside of our typical code for dealing with tax issues. So because of that slight placement issue, some of the states may need to take some affirmative action to confirm that treatment at the state level as well. Now, as Lisa alluded to, Florida acted very quickly on a related issue this week. So I think the states will start to move forward quickly on that, but it's just something to watch and understand that some of the states will need to take action to ensure that that loan forgiveness is also excluded for state tax purposes.
You want to make sure you don't have to pay tax if the loan is forgiven.
That's right. That was not the intention of Congress. Right, definitely.
Okay. And we'll be wrapping up our discussion of PPP loans here and moving into some other options you have. But we would be lax if we did not discuss the application. We're going to show you a copy of the latest version of it. Boy, have we had to receive a lot of guidance from Tierra Dorsey and other lenders out there in the markets about this. Wow, has this been the on-fire topic of the last week? What we have figured out, you can kind of see the two things we have in red here that we feel pretty confident about. One, we were starting to realize last Friday that having a previous relationship with your lender is critical. One of the stories I received was a person that had had a relationship with their bank for 20 years and had a significant amount of money in that bank, but had never had a loan with that bank. So they had a relationship, but had not had specifically a lending relationship. They were denied the loan, and how thrilled that person was to be denied a loan with someone they felt like they had a really strong relationship. So that is big. It is in this case that relationship. Also, Karen, you made a really good point when we were going over this more time of, at the end of the day, this is the lender's decision. So they will be making the decision. You might have to shop around and use your connections. What are some more?
You're exactly right, Lisa. I think that's something that people just did not realize as they entered into this. I think the majority of them thought they were going to be working directly with the Small Business Association on this, the Small Business Administration on this PPP provision, but it really is the lender's determination. The lenders are underwriting these loans. So your relationship, as you said, Lisa, is incredibly important. So just remember that your lender may have additional requirements. There may be things as part of their normal loan underwriting process that they may require that you add on to the SBA application format. So just be prepared for that. This will be a normal loan underwriting process that you'll have to go through, and there could be additional questions or requirements that your lender could impose.
That's a really good point, because they're going to ask for payroll tax forms. They're going to ask for W-2s, W-3s. And I want to credit Tierra Dorsey on really making it clear. She's on the front lines of this PPP loan application process. And what she kept stressing to me and to Kieran was, show your work, show your calculations on these applications, because what she was becoming aware of is just because your calculations weren't shown, the application would get bumped to the side. It wouldn't be processed through, which doesn't seem fair, but right now everything's very chaotic. So if you don't have everything in good format, I can see where you would get passed over for someone that had all the calculations. Another point she made was that for some of these small businesses, we know that sometimes we're always not the best at keeping up with our records. And so one of the things Tierra Dorsey was recommending was, you really need to consider getting a really good software system if you don't have one. Record keeping is not only going to be critical on the front end, but more importantly, on the back end. When the loan is forgiven, that's when you're really going to have to provide even more documentation. They're trying to push things through the process to get things quickly, the application process quickly done. But the forgiveness part, I bet they're going to be a lot pickier. I've even heard a lot of recommendations to set up a separate bank account. Now, when talking to small businesses, including my husband, he was a little reticent about this because setting up another bank account is can be difficult and annoying, if you will. So, Karen, what was your advice on this? Did you say that you want to ask your lender, or what would you do there?
Yeah, that was another area that we were hearing. Again, a proactive discussion with whoever is managing that loan relationship for you at your financial institution, I think here would be a great idea, because the lender may have some best practices, and knowing that this will have to be done on the back end, it's a lot of work for the lender as well. So again, they have the right, if they would like to impose additional requirements to make that back end process easier for them and for you. So I would ask about this up front. As you're talking to your lending officer, make sure you understand what their views are on the level of documentation that you will need to provide to support the forgiveness amount. The more you know up front, the better prepared you can be to start documenting now and making sure you have a good system in place to capture that data.
And the whole point we got to remember is, yes, we have an application process, but we got to prepare for the forgiveness request, which if it's 8 weeks from when you get the loan, this is going to be this summer. I mean, this is going to be pretty quick. We're not talking a year from now when you file a tax return. Your forgiveness request is going to be happening before the end of this year. So got to be ready for these things. Here we put some pictures up of the hilarious thing is they put out a version of this and some people had filled it out. And then the day, I believe the evening, Thursday the 2nd, they changed it that night. And so this is the latest version that we have. It's not on its face a very difficult calculation. You can see on this form that it has average monthly payroll, 0.5. It asks for your number of employees, and it asks for the purpose of the loan. Because remember, you can use the loan and forgive for rent, utilities, and interest. It also asks ownership questions. And then what's going on this page, Karen? What are we being asked here? It looks like I see the word felony. What's going on this page? We're asked a lot of yes/no questions.
Right. That's right. Again, this comes back to all of those certifications and representations that we mentioned earlier. You as the applicant are absolutely responsible, not your bank, for confirming that all of these criteria are met. So some of them go into things like criminal history, unfortunately, and whether there have been, any people connected with the business who have recently been incarcerated or things like that. But there are a lot of detailed questions. And so it's really important that you look at each of these and make sure that if you are signing the application, you are absolutely comfortable that you do meet these criteria. So some of them will be easier than others, hopefully for you to answer, but it is important to read each one.
I am aware if I am incarcerated or not right now. That's an easy question. I'll check the no box on that.
Right.
Now, you can also see some of the other certifications on this page. And then finally, you have to initial next to every single one of these. Again, we're used to that with loan documentation. This is nothing like a mortgage or a car loan here. It's supposed to be quick. It's supposed to be easier. But you can kind of see you're going to have to initial this, because one final point, two final points I want to make on this is, we're going to keep saying this. No, you cannot double dip. You cannot, and what we mean by that is, it's not that you can't do two things, it's that you can't get two benefits for the same amount of costs. We're going to move into the EIDL loan in just a minute. And yes, that's another option. We're not saying you can't do that. We're saying you can't use the same costs to get both a forgiven loan and a tax credit, to get a forgiven loan under PPP and an EIDL loan. That's what we're saying. And let's kind of end it with this. I woke up this morning to Tax Law 360 in my inbox with this title I thought was hilarious: IRS Top Cop gearing up for virus payment fraud probes. So not only are they gearing up for the rebate recovery checks we're talking about, but they have also said they're really going to be watching for what you send the PPP loan money on. And that's what these certifications are. So let's move on to our next topic. I think we were pretty thorough about PPP loans, but you do have a couple more options. One of them is the EIDL loan, which will go directly through the SBA, so that doesn't depend on your relationship with your lender. And Karen and I were really racking our brain to try to answer the question we anticipated, which would be, why would I do an EIDL loan and not do a PPP loan? So what we really tried to provide here was times when you're not going to be able to get a PPP loan. Maybe you don't have a relationship with the lender. Maybe it's possible the funds run out. I mean, it is possible. You may have costs you want loan for that are not payroll, rent, utilities, that kind of thing. This was a really neat one you found about the loan covenants. Can you talk about that one?
Right. So, one of the things to keep in mind here is that this loan is treated just like any other form of debt. So one of the things, again, that was catching some of the initial lenders from last Friday and the applicants by surprise is that these loans will be considered new forms of debt. And if you have existing debt, a lot of those debt covenants may have limits on the amount of new debt that you can take on. So it's very important to look at any of your existing loan agreements, to look and see what those limits are, and to talk to your lending officer about that. Because what you don't want to do is get into a situation with the PPP loan where that is treated as new debt and it violates a debt covenant on an existing loan balance that you had. So this is one of those situations where there may need to be alternatives, whether it's pursuing some of the credits that we'll talk about in just a second, or some of the other forms of assistance. But that was one that we thought was a great point to make to everyone.
It really was. There are reasons we're going to find even beyond those we listed. The greatest thing about this is we were on a call the other day with a woman who was a small business in West Birmingham, and she had reported that she had already received $10,000 because the first $10,000 of the loan is an actual grant. So what you have to understand, this is not a total forgiveness. Only the first $10,000 of this is a grant, as it is automatically given. She received her money right away. She said she went on the SBA.gov website, filled it out, and she got her money within 3 days. Now, you can't apply for both. What we talked about, you can't double dip for the same costs, but you may need to apply for both. Possibility, right?
That's right. And so one of the things that we wanted to clarify was that people have been asking that question, not knowing we'll get through the PPP process, as we mentioned, for all of those reasons. They've been asking, can I go ahead and apply for one of these economic injury disaster loans as well? And the answer is yes. If you were to go ahead and go through the SBA portal and apply for the EIDL provision, which is the $10,000 advance, let's say that you get that advance quickly, then what would happen ultimately, whatever amount of your loan is forgiven would be reduced by the $10,000 amount that has been forgiven. Would be reduced by the $10,000 grant that you've already received. So it is possible to go ahead and apply for both to see what happens, but just know that your forgiveness amount would ultimately be reduced by any $10,000 grant that you receive under the EIDL program.
And that makes sense. That makes sense.
That's right.
Now, they have just set up a new website specifically for this. And what we're hearing from people that have small businesses is they have a telephone line that was answered quickly, which was actually very surprising. And when we looked through these provisions, we realized that the people that could apply for an EIDL were very similar to the people that could apply for a PPP loan. You can see the under 500 employees there. You can also see the word aquaculture, which Karen pointed out. We do have a lot of catfish farms in Alabama, so that's important. I had never used the word aquaculture in my life, but there was a distinction here. If you are a farm, it's only the co-ops that will qualify for this, so you'll need to kind of look more into that. But again, even if you're not under 500 employees, you could be considered a small business concern like we had talked about for the PPP loan. And finally, nonprofits, certain nonprofits also qualified for this with these designations of their tax exempt status. Here is a screenshot from yesterday of what the portal looks like. And what we're hearing from people is it is very easy to navigate. And this, again, remember the EIDL is through the SBA.gov site. The PPP is the one that's more difficult because you have to have a relationship with the banker. Now, you can use these loans for payroll, for rent and other utilities, but also you can use it for things that wouldn't qualify for the PPP loan. And the actual quote was on the SBA site, you could qualify for the loan and use it for bills that could have been paid had the disaster not occurred. That's a pretty broad range of costs. So remember, the PPP loan costs were very specific. Payroll, rent, utilities, interest. This is kind of the whole gamut of kind of costs that you would have. But Karen, you and I read very specifically through this list because tell us about some of these. Paying yourself a bonus with these funds would not be viewed very favorably by the SBA.
No, that's right, Lisa. As we could have suspected, they have put a lot of guardrails up to ensure that people are not getting these advances and then using the money to pay themselves a dividend or a bonus or something of that nature. So as you mentioned, those would not be allowable uses of the EIDL advance funds or the EIDL loan amounts that may come after that. So there are some other things, though, just to be mindful of. There are some limitations on your ability to use the EIDL funds to refinance other debts that you may have or to pay off some of the other types of loans that you may have with other federal agencies. So just be aware, if you decide to consider the EIDL loans, there are some restrictions on the use of those funds that you need to be careful of, and just make sure that you're using them within the confines of that program.
Thank you. Now, the interest rate on the PPP was the measly 1%. This is a little more significant, but it's a fair interest rate. And the term can be up to 30 years, and you get, and you pointed this out, you do get 12-month deferral of payments, but what's the kicker on that one?
The interest continues to accrue.
Yeah, that's what you have to remember.
Because the payment,
yeah.
That's right. On all of these, just remember that it is a deferral, but the interest will continue to accrue. So you are going to owe that interest for that period.
Now, we need more guidance on this, because to get the EIDL loan, they have different requirements than the PPP loan. Now, as normally you don't have to, as normal with the SBA loans, you often have to demonstrate I couldn't get a loan somewhere else. They're waiving that. You can see they're waiving the personal guarantee if it's under a certain amount. They're only requiring collateral if it's over a certain amount. But the two provisions you and I were discussing were they want you to have acceptable credit history and the ability to repay, but we don't have any numbers. So Karen, what do you think how would we demonstrate that?
Right, so keep in mind, these are normal loans through the SBA process. And the SBA does have the ability to request additional information to support your ability to repay. That could include the personal tax returns of some of your key partners, your member managers if you're an LLC. So keep in mind, you could see requests for additional information under the EIDL loan process to prove that you do have the ability to repay it.
So it's more onerous process.
That's right.
But you might have the PPP problems. Now, what we've got here, we won't go too much into this. If you're a faith-based organization, they just put up a list of FAQs on their website that address how this process works. Because remember, nonprofits, they even get a percentage off. It's only 2.75% annual rate for nonprofits. And there are specific guidelines for faith-based organizations. And I was asking you, Karen, exactly what a secular social service was yesterday. But again, if you're a faith-based organization, you would look farther into this. So we won't go too much into that. So, all right. So we've talked about the PPP loan. We talked about the EIDL loan and the possibility of the grant. So let's kind of move through this. There is a whole nother option for a tax credit. This is a payroll tax credit, not an income tax credit. It can be an income tax credit. We'll talk about that in a minute, but it's generally a payroll tax credit. And remember, we're talking about FICA and Medicare. So generally FICA is 6.2% borne by the employee and the employer up to a certain amount of compensation. And the Medicare part is 1.45% borne by the employee and the employer. And the exciting word on this screen,
refundable, because we don't see many of those in the tax credit world. Lisa, I could honestly count on one hand the number of refundable credits that we probably have access to right now. And this new one is great because not only is it refundable, but there is a way that you can go ahead and apply for what's known as an advance credit. And I know we had some questions come in about this because people are hearing about this provision. So let us cover that just quickly for all of you who may be interested. So this credit, which is up to 50% again of the first $10,000 in wages that you're paying to an employee, is refundable if you are in a position where you need the cash and you don't feel like you can wait to claim the credit on your normal employer payroll tax quarterly filings, which would be the 4941 that will be coming due for the second quarter in just a few weeks. If you feel like you need it before then, there is a way to file what's called a Form 7200 and request an advance credit. So with that form, and Lisa's got a copy of it up, it's possible to even see this refund come back to you more quickly than we would have ever imagined. So this was one of the helpful pieces of guidance that we got from the IRS over the past couple of days. But this is an incredible opportunity as well. So as you're thinking about the PPP, keep in mind that you may want to run the numbers just to see what you would get under the employee retention credit as well, because at $5,000 per employee, that can be a significant amount that could potentially be available to offset your otherwise obligations that you would have under the payroll tax program, where you have responsibility, as Lisa said, for Social Security and Medicare tax as well.
Thank you, Karen. And just we'll kind of briefly note these. You can't double dip. I know we keep saying that. You can't take these two kinds of credits. You can't get the PPP loan and use those same costs for this credit. Qualified wages are going to be considered those that were paid while you had closed or reduced operations. You can see the time frame goes all the way up to the end of the year, which is pretty unbelievable, which is also pretty scary and depressing. And then you can kind of see an eligible employer. Here's the point we were really harping on yesterday was your size doesn't matter in this case. We keep talking about 500 employees. Here it doesn't matter at all. To be an eligible employer to take this tax credit for your payroll taxes, you just have to meet the requirements that one of these two requirements, fully or partially suspended operations, or your gross receipts had lowered. And we were really noting that once your gross receipts recover to 80% of what they were in the prior calendar before this all hit, you can't take the credit anymore. So that's what an eligible employer is. And Karen, can you this about the eligible employees? There's a big difference between whether you have 100 employees, we're talking about full-time, or less than 100. And does this have to do with whether they're actually working?
That's right. This was another thing that a lot of people didn't realize. Depending on where you are in terms of your employee count, it's important to understand what wages would go into those applicable wages that, again, you're using to determine your credit. If, as Lisa said, you have more than 100 full-time employees, what you're counting are the wages that you're paying when the employees right now are not providing services because of the COVID-19 disruption. So that would apply, again, to wages that are not associated with services at all right now if it's more than 100 employees. But if it's 100 or fewer employees, you do have the ability to include all wages, whether or not the employees are performing services right now. So that's a big distinction that you have to keep in mind as you're trying to calculate what your base would be that credit would be calculated off of.
And we'll make one final note on this. Again, you cannot take the PPP loan and this tax credit. So you got to kind of think through all your options. We've got a few more things here. I know we're getting long. There was a lot of activity and a lot to talk about. Let's look at our last set. This was the act. The Families First Act was the one that was passed first before the CARES Act. And so the excitement, one of the exciting things was that the tax filing dates, but gosh, you rarely ever see this. The extension of the payments to July 15th. which we're going to talk about in a minute, may cause some problems at the state level. But all my friends at tax firms, I was like, are you excited that the deadline was extended? And they're like, no, because tax season goes on forever. So I hadn't thought about them at all. But let's talk about some of these other things that were in the first act that was passed around March 12th. Let's kind of look at those, and this will be our last set of material we're going to talk about. Everyone's talking about the recovery rebates, and everybody's wondering when that's coming. And you're seeing articles about, oh, it could be months or it's coming now. And also, the big shock, and you helped me understand this, Karen, was it's $1,200 a person, $2,400 if you're married filing joint. But the child definition was one that caught everybody off guard. Karen and I have a lot of contact with college-age kids that are still dependents of their parents. And so you had a lot of questions from people in your class asking you, am I going to get the check? So what did you find out there, what a child was?
Right. So this one was an unfortunate piece of news that I had to give a lot of my students, as Lisa said, who were asking this question. When they define who a qualifying child would be, used a specific provision in the Internal Revenue Code that references children, unfortunately, under the age of 17. So this is one thing to remember. If you have a dependent child who's still being claimed on your return who is over age 17, unfortunately, you won't get the additional $500 for that child if they're over age 17. So that is just something to keep in mind. As Lisa said, being in a college town, it was one of the most common questions that we got right off the bat. Yeah.
Although they act like children sometimes, they're not being treated as a child for tax purposes. Now, Jay-Z and Beyonce will not be getting their recovery rebate check. So the Kardashians will not be receiving their check. You can see the income limits for married filing jointly around $200,000 of adjusted gross net income, no check. You can see it gets phased out between $150,000, $198,000 if you're married 75 to 99. You'll get less of a check. Is that correct? There's going to be a phase out, so there'll be partial checks?
That's right. There will be a phase out. You're right. At those levels that you just mentioned, unfortunately, you'll lose the entire amount if you exceed those. But there will be a phase out for those people that are in between those two levels.
Now, one of the big questions also was, what do I need to do to get it? And what about some of our retired folks? So what we're hearing is if you have filed not only a 2019, but also if you have filed a 2018, you're good to go. And if you had direct deposit information on that 2018 or 2019 return, you're fine. They will put that in that bank account. Now, they also say they're about to open a portal where you can enter your direct deposit information if it's different or you didn't have that on your last return. And tell us, Karen, about the retired folks, maybe some of our veterans with VA benefits or our Social Security recipients. They've got a little different process.
That's right. So initially there was a lot of concern because when this program was first announced, initially some of the Treasury Department officials said that they were going to require everyone to file a return. Well, we have a lot of people that receive Social Security benefits who don't otherwise file a tax return. Thankfully, through the intervention of a lot of the groups like the AARP and others, they were able to quickly point out this issue. And so we now have that resolved. And for people who are already signed up and receiving their Social Security benefits through the normal Social Security direct deposit program, they will receive their stimulus checks the same way through that same bank account that they receive their Social Security benefits. So we got it cleared up for the Social Security recipients, thankfully. The two areas that are still open, though, are the VA benefits and the SSI, which are the additional benefits for the people over age 65 who are elderly or disabled as well. So we're hoping to get additional guidance over the next couple of days for those individuals also.
Okay, so I guess checks are coming. Two other little rules we want to mention are if you have a retirement account with funds in it, we know that you cannot take out money before you turn 59 and a half, or you have a 10% early withdrawal penalty. Well, over the years, we've seen that they'll give hardship relief, medical costs. There was a first-time home buyer at one time. Now, in this case, they've extended how much you can take out and said, if you need to take out retirement money at this time because of this pandemic, the penalty won't apply to you. Now, obviously, you still have to pick up the income from that because you put those retirement contributions in and didn't have to pay tax on the interest-free. So don't you have two options, Karen, of what you can do for income tax purposes?
That's right. So the good news here, they're giving people two options, and both of them are great. We don't often see this with retirement account distributions that are taken early. So one thing that you can do is you can choose to spread that income that, as Lisa mentioned, you would have because you haven't paid tax on these amounts yet. You can spread it over a 3-year period. But the other thing that you can do, which this is the first time I've seen this provision in this area, they are allowing you to recontribute the money back in over a 3-year period as well to avoid that income recognition. So this is another way, if your business is in need of cash and you're looking for options, there is the potential for you to be able to take it out of your retirement account. You're not subject to the early withdrawal penalty. You also, if you think the business will recover in the next 3 years, could put it back in and avoid taxable income as well. So this is something to think about just as businesses look at all possible sources of cash. Definitely something that you want to keep on the table.
Another small thing that got passed was we know that 2 years ago they changed the rules, doubling the standard deduction in an effort to reduce the amount of people itemizing, filing Schedule A on your 1040. So a lot of us are not itemizing now. So we know that a lot of us are making charitable contributions. We're getting a lot of requests for need. And so they provided an above the line deduction, meaning if you do not itemize, you can deduct up to $300. That's not a huge amount, but it's something. So even if you don't itemize, you want to retain those receipts. Everyone will get the benefit of that without itemizing. One thing we'll quickly move through is one more tax credit option. This was one that was passed before the payroll retention credit. And again, this was in the Families First Act in around March 12th. If you are willing to pay your employees extended family medical leave pay during this period of time, the government is going to give you, again, refundable payroll tax credits. If you are self-employed, these will be income tax credits because that's how the payment of self-employment taxes is handled on your self-employed return. Now, what we just want to address is, notice it's less than 500 employees, so only small businesses and the self-employed. It's refundable payroll tax credits, and it's sick leave and child care leave. So let's just briefly look at this. We don't want to go too far into this, but they will give you a payroll tax credit for up to 2 weeks, regular pay, 40 hours a week, 100% of wages, and that'll be your payroll tax credit, and that's capped at $511 a day per employee. And this is what's defined as paid sick leave, subject to a government quarantine. You're being tested for the virus, or you've been advised to quarantine by a healthcare provider, or you're caring for someone that meets any of those orders. So that's what's considered paid sick leave. And then I joke a lot about my dismay over the schools being closed and having 3 children running around. A lot of us are dealing with children running all over the place where we're trying to work. And frankly, let's just be honest, I'm almost unable to work with all these children around. So if you are unable to work because you have to care for children, also your employer may help you out during that time. That's their discretion. What they get for that is the refundable payroll tax credit. Now, one more item we want to note here is the opportunity to defer payroll taxes. You can defer your payroll taxes to the end of 2022, which seems like a long time away. But Karen, should we take advantage of this? What are your thoughts? Are there any risks of deciding I'm not going to pay my payroll taxes for 2 years? Any problem with that?
Well, I think what a lot of the CPA firms are worried about, and what we're hearing they're telling their clients is that with that lengthy of a deferral, which will occur over a 2-year period, it's important to remember you do have that obligation to pay it in. So I think a lot of the firms are trying to remind their clients that this is not your money. When you've withheld those payroll taxes from your employees' paychecks, you have a responsibility to remit that, and that responsibility is not going to go away. So a lot of the firms we're hearing are advising their clients to consider not taking advantage of the deferral and going ahead and paying it in, just to make sure that those monies don't inadvertently get used for something else that would make it more difficult for you to pay it in later when it's due in 2021 and 2022. So it's just something to keep in mind. Again, that's just, some of the views that we're hearing from the CPAs and the firms in this area. You may have a different perspective, and that is definitely fine, but we just wanted to share some of the things that we're hearing the CPAs advise their clients.
Practical advice, yeah. We're wrapping things up. We got a couple more items we want to point out. If you owned a retail establishment or a restaurant, if you were an accountant or a financial advisor, the hottest topic of the last 2 years was the guy at the Treasury that deleted a sentence that caused chaos. And let me kind of just put this in perspective, and Karen has some really good insight on this. There was a glitch, totally not intentional, where improvements made to the interior of leased premises, restaurant, the inside of a restaurant, the inside of a retail establishment, you could take that cost and deduct all of it. You might have heard the phrase bonus depreciation. You could deduct 100% of that cost in 1 year. In 2018, it was supposed to be, or 2019. Now, we can't glitch with fixed, and I don't want to make this joke, but it literally took a pandemic for this glitch to get fixed. We never thought this glitch would be fixed. Here's what I want to make the point. Without this glitch being fixed for a full 2 years plus, these costs defaulted to being deductible over 39 years. 39 years. Now, you could carve out some of them as 5 or 7 year property, but the basis of this was because there was an accident at the Treasury or somewhere where someone deleted one line. We won't go through that. The items that were supposed to be deductible over 1 year became deductible by default over 39 years, which might as well not be deductible at all. So I can't believe it took a pandemic to finally fix this. I thought a couple of weeks ago, I was like, you're kidding me. This is what it took? But talk to us about restaurant owners, retail owners, and people that have leased property. They have the opportunity to amend returns, but what are our potential problems here? There's some real technical issues here.
Right. So what I would say, if you are in one of these industries that potentially has been impacted by this, it's important to think through the method of getting your money back. So initially, I think a lot of people jumped on the amended return option and thought, oh, we need to start amending these 2018 tax returns immediately and getting those in. Now, that is still something that may be your most beneficial route. But we wanted to make you all aware that the IRS at the federal level is offering another option as well, which is through a form that would allow you to basically catch up that depreciation and report the additional deduction on your 2019 return. Now, as we mentioned, because we got this great deferral of the time period for filing our 2019 returns, most of those 2019 returns are still outstanding and have not yet been filed. So it may save you some administrative time and cost by potentially considering the ability to just take this additional deduction on your 2019 return as well. Now, the other important thing to consider is that if you do choose to file an amended return for federal purposes, you may get your money back quickly at the federal level. But remember that the states have deferred their time period for which tax payments are being required as well. And as we all know, anytime the state does not have cash coming in from tax payments, it makes it difficult for the state to pay refunds that are due as well. So depending on the state that you're in and how long that deferral is, just be aware that with an amended return, your refund may be on hold as well until the tax starts coming back in once those payment requirements are reinstituted. So it's something that you just need to consider, depending on how quickly you need the cash. Look at both options. It could be that the 2019 option is the better one for you.
And you might need to consult your tax accountant for further advice.
Definitely.
If you have
Definitely
a
on
CPA,
this one.
that'll be what they need to do. One more very interesting thing that came out last night, because like I said, I think Karen stays up all night just watching these things come out. This procedure from the government came out last night, unbelievable, about how partnerships, the way that the IRS audits partnerships has changed significantly. And so, Karen, tell us a little bit about this little technical glitch that might have prevented you from filing an amended return to get this huge deduction.
That's right. So not surprisingly, for all the businesses that are organized as partnerships, you're probably aware that over a year ago, the government started a new approach, as Lisa alluded to change the way partnership returns are audited. And under that approach, now there are certain circumstances when amended returns are prohibited at the partnership level. So immediately, a lot of those partnerships that are under this new audit approach at the federal level said, well, wait a minute, because of this, you are going to delay my ability to receive my refund that I'm entitled to. So late last night, hot off the presses, the IRS decided to release a revenue procedure, which will reduce that waiting time for those refunds, thankfully. It is going to grant that option to file amended returns to the partnerships for both 2018 returns, and if we did have partnerships that had already filed for 2019, they can amend those as well. So thankfully, we were able to get quick relief on that. If it is a partnership that has the QIP issue and is entitled to these additional depreciation deductions, they can quickly amend the returns, get those amended Form K-1s out to their partners, and the partners could then amend their individual returns as well.
Thanks. All right, we're almost done, guys. Hang with us. Now, if you happen to have an employer that generously wants to give you assistance during your tough time, now we're not talking about payroll, we're talking about different things, almost like a gift. Wouldn't you call that, Karen? There's a nice tax benefit. You rarely see the win-win of something that's deductible for the employer, but not income to the employee. Boy, you rarely see that. That's like a 1 in a million. And so, was this code section 139? Is that what it is?
That's right. And this is one of those, I will call it hidden gems, that as Lisa and I were talking a few days ago, I'll be honest, did not hit the radar screen and still isn't on the radar screen of a lot of groups and individuals. There was a provision that was passed back in the 9/11 era, back in 2001, that basically allowed employers to provide payment of what we call reasonable expenses to cover even some personal items such as funeral expenses and things of that nature. They could make these payments to their employees, and as Lisa explained, the employee would not have taxable income, which is normally the case, and on the other side, the employer who is making the payment would also get a deduction. So up until March 31st, there was a lot of confusion and uncertainty as to whether or not the coronavirus pandemic would qualify as the type of economic disaster or, typical disaster declaration for which an employer could make these payments. The good news is the IRS, in one of the frequently asked question documents that they posted on March 31st, did affirm that they believe the coronavirus pandemic will qualify as an eligible disaster. Now, that being said, they've got a lot of additional guidance that they would need to release to us then on how these payments could unfold. But we wanted to put this on your radar screen. We've heard of a lot of businesses that are wanting to help their employees in some way. This could be a way to do it, which preserves the deduction for the business and allows the employee to receive this payment without having taxable income. So as Lisa said, it's a win-win situation. We'll continue to watch the guidance. Hopefully we'll have some soon over the next couple of weeks from the IRS that will clarify exactly how this program could be used.
And we are wrapping this up with a final discussion of something Karen knows quite a bit about. I believe you're working specifically with certain people in Alabama about how everything will shake out with conformity issues. where are you guys on that? I know there's a lot to be done.
Right, Lisa. As we've mentioned throughout this discussion, there are a number of areas where we may need to see some state action to preserve some of these benefits for our individual and business taxpayers. So we are obviously working under a legislative session that has been significantly reduced because of the pandemic. So the goal right now, there's a lot of dialogue going on with the various parties of Montgomery, the legislators, the Department of Revenue, and others to try to quickly get their hands around these provisions so that when the legislature does come back, which could be as soon as April 28th, they can act quickly to take whatever statutory actions may be necessary to ensure that the citizens have certainty around these provisions and what the tax situation will be in Alabama. So that is ongoing. A lot of people involved. We're making really good progress, and I think hopefully we'll have some good news to report soon on that. And in the meantime, though, the State Department of Revenue has announced that they are also allowing businesses to defer paying in their sales tax liability that otherwise would have been due. Again, it's without penalty. You get the deferral, but as we've said so many times, it is still subject to interest. So just be mindful of that, but that was something that came out about a week ago from the State Department of Revenue as well.
Well, we have an opportunity to take some questions. I think we've addressed a lot of technicalities, but at any time you want to contact either of us, I want to say a huge thank you to Karen. Amazing technician on this. But Zach, do we have any questions?
Yes. So we have a number of questions that have come through in the Q&A and in the chat function too. So I can go ahead and just pull a few out if you'd like.
Sure, go ahead.
Okay, sure. So going back, let's see, into the chat. Let's see. Narissa St. Fleur asked, I'm a food truck owner along with my mom, 50-50. I do not get a paycheck, but have been affected as all our events and catering gigs have been canceled. Are there any options for a small business of the type that has no employees but is having loss of income?
Definitely. So that's a situation where as someone who's self-employed, it sounds like it's what you would be deemed. You can start to take advantage of some of these programs. So for self-employed individuals, that PPP program that we talked about opened up today. So it's definitely something you should look into. You might also be eligible for the EIDL grants that we mentioned as well through the Small Business Administration. So you could go through that portal and take a look at that application. Again, we're hearing great success. People that have gone on it have said it was a very fast process. They got a lot of support from the Small Business Administration throughout their application review. So it's definitely something that you should consider. Both of those may be attractive options.
Isn't the point that needs to be made there is even though she has no employees, that's not a problem. If you're self-employed,
right.
They look at your Schedule C net profit. So
That's
that
right.
has nothing to do with payroll. So that's where you would go. The PPP loan will not consider payroll costs. It will consider Schedule C net profit.
That's right, Lisa. Thank you.
Very good. And then Patricia asked a question. It says, on March 9th, I signed a severance agreement with my company. They are paying me through May 9th, but they terminated me. If I do not have a job by then, should I file for unemployment? I may be self-employed at that time doing 1099 work, but I did not do any 1099 work in 2019.
I would say there, what I would recommend is looking at the Department of Labor site that Lisa posted the link for. They have received a number of questions very similar to that, and they've got some guidance on their site. So I think probably the best resource for you, given your situation, would be to take a look at that Alabama Department of Labor site. Lisa's going to pull it back up now so that you'll see where to go. But that should give you the guidance that you need, given your specific facts. So
boy, they had every category possible. I mean, they were extremely specific. So you can kind of see that they will lay out exactly what you need to do. They've done a really good job of that.
Very good.
That's right.
A few questions have come across about the EIDL. People have asked if I, hold on. Sorry about that.
No, working at home.
People have asked about small children at home that were outside have come inside. They've been asked about refiling the EIDL after changes have been made. So the person filed the EIDL on the first day with changes. Now asking, do I need to refile? Or is it one filing is enough?
Right. And I will tell you, this is just one thing we heard from Tiara the other day. She said that some people who filed initially had not received a response right off the bat. And she did know, and this is just anecdotal evidence, but of a couple of people who decided to go ahead and put in another application. And when they put in the second application, they did hear back quickly within 48 or 72 hours. So again, this is just anecdotal evidence that we're hearing, but the lending officer that joined us earlier this week did mention that some people had tried that, and that helped them get an affirmative response from the SBA within a very quick time period.
You're saying, Karen, that they had filed it, had heard nothing,
That's right.
and filed a second one. Was it a duplicate? Like it was the same request?
It sounds like they
acted like.
Yeah.
Oh, I'm sorry.
It just, the way it was phrased, it sounds like they filed it once and then made changes, and then they're asking if they need to refile it again. So I'm not quite sure. Those are all the details I have.
Okay. Well, right. And on that, I would just encourage you, there is a phone number at the bottom of that EIDL application screen. What we're hearing is that the SBA is answering those calls very quickly and that the people are very knowledgeable. So again, this is just anecdotal evidence that's coming in to Lisa and I, but we are hearing that those SBA loan officials that are answering that 1-800 number that's at the bottom of the screen that Lisa's pulling back up have been very helpful.
Let me see.
I don't know that it's on our screenshot.
So disasterloan.sba.gov? Yeah?
No, there should be I think it's a 1-800 or 1-888 number that was there too on that first information screen. So on one of the two, it should be there, but we can send that out. I know we're going to send supplemental material with that. We'd be glad to do that.
And I think what we might do is I read some of the questions that we've gotten, and then maybe we could just use this as an FAQ, and in the email follow-up, we'll just maybe try to answer some of those after taking a look at them. And I have another question that came from Eric. He says, if I have ownership in multiple businesses, can I apply for PPP/EIDL for all of them, or will mutual ownership impact the loan amounts?
And I think that would be, when you go through the slides that were sent out, the affiliation rules. So if there's common control through ownership, management, and identity interest, then what you're doing is treating them as one for purposes of the 500 employee rule. And Karen, what did you find today about whether you have to file, how you would deal if you have separate businesses that are affiliated? Do they file one PPP loan request, or do they file separate ones?
Right, and that was a frequently asked question that we were seeing coming in from the past few days, and unfortunately there was no clear answer. The best advice they were giving people is talk to your loan officer. Again, there are significant certifications and representations that have to go on that loan application about your affiliated entities. So we would encourage you to ask the lending officer for the bank that you're working with about their view on that approach.
Very good. Okay, Felicia asks, isn't the EIDL grant of $10,000 based on the number of employees with a maximum of $1,000 per employee with a cap at $10,000? So if I have 3 employees, I can only get a maximum of $3,000?
That's a good question. I don't know that answer. Do you know that answer, Karen?
No, that is a good question. We'll be glad to get back to you on that. That is not one that we have had to look at yet, but we can check on that and try to get back to you.
I think the woman we had talked to that got in the grant didn't have 10 employees. So maybe there's another condition.
Right.
I'm pretty sure she only had herself. So we'll look into that. We'll put that in the FAQs.
Okay.
Right. We'll be glad to.
Very good.
Zach, you want to do one more, or you think that's enough?
How about this one? This is interesting. Kelly asks, what about business and LLC that is in the process of trying to open? Would they be eligible for the IDL?
Yes. That's my understanding, Karen, is the EIDL doesn't have the requirements that the PPP loan has. What are your thoughts on that, Karen?
Yeah, and I know that they have been, even under the PPP program, they've been looking at businesses that were just getting up and running. And that was one of the other questions that came in a lot this week. So there were some of the lending institutions requesting guidance on whether or not they could look at just the first couple of weeks, even, if it was the beginning of March or the end of February. So talk to your loan officer about that, because we were seeing that coming in from the lending side as a frequently asked question over the past couple of days. I'm not sure that we have definitive guidance yet, but I know the lenders have raised it.
I think the EIDL loan would be more available potentially than the PPP loan, because the PPP loan is based on payroll costs and retention of employees. So to me, the intention of the EIDL loan is different. The PPP loan entire point is to retain employees, right? So to me, a new business would have more success with the EIDL. I don't think it might match too well with the PPP loan.
Yeah, no, that's a good point. The amount that you might be able to get to the PPP, even if it was an available option, may be lower. So that's a great point, Lisa, to consider about the EIDL.
Yeah, I'd start with the EIDL. Yeah.
Okay.
Well, thank you, Zach. Thank you for that.
The thing. So, well, I think what we'll do is it's going to be a few days, but we'll get all the questions together that weren't able to answer. Kind of put together an FAQ, and we'll send the follow up with some materials and the video to all those who have registered. And you'll be able to find those on the Culverhouse website at culverhouse.ua.edu. So we're gonna make all this stuff available. And so be on the lookout in your inbox probably early next week for all this stuff.
Thank you, Karen. Thank you, Zach. I really appreciate it. I enjoyed it. Thank you, guys.
Thanks to all the participants. It's
Thank
great.
you, guys.